Mortgages underwater? Well, the latest news article that I saw says that there has been an uptick in mortgages underwater across the US. So, do we have something to be worried about? Let's take a look. Thanks for joining me, you guys. So, this article from Yahoo Finance, seriously underwater, home mortgages tick up across the US. This is saying that nationally, 2.7% of homes carried a loan balance is at least 25% more than their market value in the first few months of this year. That's up from 2.6% in the previous quarter. This is according to Home Equity and Underwater report from Adam, a real estate data firm. So, okay. Yes, there is an uptick from 2.6 to 2.7%. Also, 2.7% is still extremely low. So while this headline can be a little bit concerning, if we look at these numbers, we're still very low as far as, the across the country homes underwater is concerned. They do talk about several southern states saw shares of seriously underwater homes grow more than the rest of the country. So Kentucky's share jumped to 8.3% in the first few months of the year, from 6.3% the previous quarter. West Virginia rose to 5.4% from 4.4%, and Oklahoma climbed to 6.1% from 5.5%. Arkansas 5.7% to from 5.2%. The states with the biggest increase in number of seriously underwater homes are also in the South. Kentucky is in first place. They also have Mississippi and Oklahoma. So, as of now, Arizona seems safe based on this data. It's mostly in the South, but it is something to watch out for. Still relatively low across the country, homes that are underwater. But obviously, there's been, a lot of changes in prices and mortgage rates with the real estate market. And it's no surprise that we're seeing a little bit of this. So if you are not familiar with what that term means, basically it means that you took out a loan for more than what your house is now worth. So you owe more on that mortgage than what you could sell the house for. Now, this becomes a problem if you need to sell the house. If you don't need to sell the house and you still have an income and you're able to afford your mortgage, then it sucks, but you just keep paying your mortgage and eventually your home value will increase over time if you're going to be there for the long term and you get out of that situation. That's the hope. Now, that doesn't always work that way. And if you have to sell at a time when you shouldn't be selling and you can't get your money out of the house, then we have a problem. So that's the situation as far as mortgages underwater. Now, I figured let's take a look at foreclosures because as we've been talking about changes in the real estate market and an impending crash, as everyone wants to say, a lot of people talk about foreclosure rates. And this is for Phoenix specifically. I don't have any data on the number of homes underwater in Arizona, but I do have foreclosures. And as you can see, they're real minimal. And this is the notice of trustee sales. So I've shared this before. This is not the number of homes being foreclosed on. This is just this initial notice for these homeowners that they will go into foreclosure if they don't come current on their payments or, they have the option to sell as well. So we're averaging somewhere around 300 a month. As far as May is concerned, only 43 notices of trustee sale have come out this month. Very minimal. Obviously, you can see where we were at in 2011, 2010. That was much different. But even in kind of those normal balanced market years, 2016, 17, 18, still we're about half of what we were seeing then. So very low. So I said if your home is underwater and you can continue to pay your mortgage payment, that's okay. But we have to hope that the people who have homes underwater have a lower mortgage rate, that they bought, maybe at the height of the market, but they got a low rate because rates have not been very pretty lately. And in fact, housing experts are revising their mortgage rate forecasts for the remainder of this year. Now, Why is this? Well, they're saying the Fed's holding the benchmark rate steady, inventory shortages, elevated home prices, all of that is expected to continue. And so nearly halfway through 2024, the anticipated interest rate cuts have yet to happen. If you remember at the beginning of the year, there were a lot of forecasts that not only the Fed was going to cut the rate a few times this year, but also that would impact mortgage rates and mortgage rates would go down. We all expected at this point in the year we would see stronger home sales activity and interest rates would be down. The deputy chief economist of the National Association of Realtors said that. But rates have moved back up to the 7% range. It puts a damper on home sales activity and changes who can purchase a home. So given all of this uncertainty, the experts are changing their forecasts. So Fannie Mae has increased its year-end prediction to a mortgage rate of 6.4%. Originally, they said 5.9%. National Association of Realtors has changed to 6.5% from 6.3%. And Wells Fargo says that they're changing their outlook to 6.5% from 6.05%. So, bottom line, all of these are about like the mid sixes is what everyone's outlook is to end the year. Whereas before they were hoping for low sixes, maybe high fives. So where are we today with rates? Well, mortgage rates dipped below 7% for the first time in 5 weeks, giving buyers some much needed relief. Now, this came out on May 16th, so it is a little bit dated. What's actually going on? Well, last week we got the CPI report and it was positive news. The April CPI rose by a softer than expected 0.3% month over month and 3.4% year over year. So it's showing that inflation is easing. We're not at that 2% target, but it is positive news. So the markets reacted positively. So May has been a pretty good month for mortgage rates so far. We've seen some decrease in the rate, a little bit of easing. As of Friday, however, they're saying, Mortgage News Daily is saying mortgage rates have had a great month of May so far, with almost every day being a winner up until yesterday and today. So last week, Thursday and Friday, rates went up a little bit, but they are saying the 2-day losing streak began from the lowest levels in just over 5 weeks. And so as of last Friday, today's rates would still be the lowest in more than a month. So it's positive news for mortgage rates, although there isn't any, significant movement. We're not seeing those mid sixes by any means. We at least saw some trend in a positive direction. And for right now, we're a little bit stagnant there, but check in with your lender if you're house hunting right now, because that could make a difference on what your payment looks like in a positive way. And if you're at that point where you're able to lock in the rate, you may want to talk to them about your options in doing that. So speaking of rates, I thought this was an interesting article, how rich homebuyers are avoiding high mortgage rates. If you can't guess what the answer is just buy in cash. Easy peasy, right? We can all just buy in cash. Luxury housing markets in New York and Florida are boasting near record high shares of transactions paid in cash, according to first quarter data from real estate appraisal consulting firm. This represents a sharp reversal from more mortgage dependent deals during the pandemic when interest rates were considerably lower. And that's interesting because you don't really think that people who have the cash, you would think that they would want to just use the cash, buy the house, be done, not have a mortgage. But there were a lot of people taking out mortgages that didn't need to during that environment when rates were so low, because it was basically free, as they said. So why not get a loan and keep your cash and be able to do other things with your cash? And now all of that has reversed, where people who have the ability to pay cash for a property are interested in doing that more so than getting a mortgage, because the rate is just so high and the amount of interest they're going to pay over time just doesn't make sense. So I figured let's look at how many cash transactions we're seeing in the Phoenix area as of right now. And we're about 23%, 25%, 20% over the last year or so. So not much change in terms of the number of cash purchases. Where we saw a lot more cash purchases was in 2021 and 2022. And I think a lot of that was investor purchases more than it was luxury home purchases using cash, because like I said, a lot of them were opting to just get a mortgage because the rates were so low. Now, the way home prices have gone in combination of interest rates, there is an argument to be made for renting versus buying. Renting can be more affordable depending on what you're looking at. And then, of course, you don't need a down payment to rent anything. So I thought this was interesting. This is the latest in terms of rentals, and this is nationwide. Sunbelt cities see fastest rent deflation amid building boom. 9 of the 10 cities with the steepest drops in rent in April were in the Sunbelt, according to this new report by Redfin. So they go on to say the median asking rent in Seattle dropped 7.3% year over year in April in Seattle. This is the biggest drop among cities analyzed for this report. They also saw Austin, Texas, rent fell 6.6% in April. In Nashville, it fell 5.9%, Jacksonville 5.6%, San Diego 4.7%, and Phoenix makes this list, Phoenix at 4.6%. So if everyone is interested in renting because it's more affordable than buying, then why are we seeing rent deflation? Well, it comes down to an inventory situation. This is saying there's 2 factors to this. A construction boom has resulted in new apartment inventory becoming available and driving prices down, and prices in the Sunbelt markets continuing to retreat from their feverish pandemic era highs. And we have seen a lot of construction going on for multifamily. In fact, we have seen all-time high permits for multifamily buildings. So I expect this to continue. Whether we'll see a big dip in rental rates in Phoenix, I don't know, but I do know that the inventory for rentals is going to continue to climb, especially as multifamily. Now, if you are a mom and pop landlord and you have single family homes to rent, it might be a little bit of a different market versus those who are renting more of those like condo, apartment-like properties, because there's more competition for that typical multifamily out there. Now, if you're new here, every week I am here on Tuesday giving an update on what's going on in the Phoenix real estate market. And I also incorporate what's going on nationally with the economy as much as possible. So hit that like button and consider subscribing if you want to be here with us every week. Last week, someone asked me if I could continue to share this contract ratio heat map every week, and I most certainly can. The contract ratio is comparing the number of listings that are available for sale to how many are under contract. And so if you have a ratio where you're seeing more homes that are available for sale than what's already under contract, you have more supply options. Obviously, it's not as hot of a market. If you flip that and you have more homes under contract versus what's available for sale, then you have a much hotter market. There are fewer homes out there for buyers to choose from. Therefore, there's going to be more competition and it creates a hotter market. So as you can see with most of the Phoenix metro area, we're seeing a lot of the green, which is balanced and warm. We're also seeing a good amount of yellow, which is hot, and 80 and hotter is that red, like 80 to 100 range. And we're seeing a bit of that as well. This is all really broken down on zip codes. So if you're interested in a particular zip code, drop it in the comments below and I will get you that info. As we look at some of the hotter areas of the valley, you can see a lot here in the southeast and southwest valley, Levine being one of them. Moving over to Chandler and Gilbert is a hot area. Even down here in Santan Valley, Queen Creek area. We've also got some areas of Scottsdale and Phoenix, 85254, 85054, 85024, and 85083. Now, the difference between this and the Cromford Market Index, which I share every week, is that this is much more real time. It is not adjusted for seasonality. It just shows what's actually going on at the time with active listings. Now, the Cromford Market Index is looking at supply and demand and also taking into consideration how quickly homes are going under contract and that kind of thing. So the Cromford Market Index is showing us overall in a balanced market. Anything under 110 is considered balance. Anything under 90 is considered a buyer's market. So that 90 to 110 range is balance. Demand is at 79.5, which is about 21% below normal, if 100 is that normal range. And then supply is at 73, which is about 27% below normal. So as we continue to look at this, we're still seeing supply being lower than demand. Demand just went down a bit. I think it was at 80 last week, somewhere around there. And supply has been increasing. So let's look at the number of active listings on the market, because I I know that's a factor that all of you like to see often. And we're at about 16,227. We are up from 16,031. You can see it's a very slight increase, but our supply has been increasing since the beginning of the year pretty consistently. Now, if we look at every major city and their respective CMI, we see that Chandler is still leading the pack and Maricopa is at the bottom in a buyer's market. Chandler is in a pretty strong seller's market. Even though we look at it month over month, there's been a 2% decline in the CMI, meaning that it became a bit less of a seller's market, even though it is still very much a seller's market there. Now, any of these cities that are in a balanced market range, we have Goodyear and Surprise are the only two in a balanced market. Everything from Paradise Valley to Chandler is considered a seller's market, and everything from Cave Creek to Maricopa is considered a buyer's market. Now, overall, the average change month over month for these cities is only 0.8%. And last week it was 1.8%. So we saw a pretty significant difference, kind of reversing the trend. We've been seeing everything moving towards a seller's market as of late, and now we have gone away from a seller's market. Not a huge percentage, but something to watch. It could be a new trend. So as I always say, different areas of the valley behave differently. Some cities are much more of a seller's market than others, and some cities are much more of a buyer's market. So depending on where you're located, it could vary. If you are a homeowner considering selling your home and curious what your home value could be, check the description below. I have a link where you can get an instant home value. And buyers, in that same link, I have some additional resources where you can use our MLS to search homes for sale. Now, I want to know from you, are you concerned about homes in the Phoenix area being underwater? Put it in the comments. Let me know what you think, and I will see you guys next week on my next market update.